Alright, welcome back to Archi Lens. Today we're gonna talk about where your money actually goes. Most of off-plan investors think they're buying real estate, but structurally, many of them functioning like a banks. Except banks charge interest. Banks demand protection. Banks also control risk. But most investors do none of that. And that becomes very dangerous, especially when market changes. In the last video, I said I would only deploy capital with top-tier governmental-backed developers, but I did not explain exactly why. And the reason behind that has nothing to do with branding, or marketing, or luxury showrooms, but it has to do with something much deeper. Because behind every developer, there is a financial system, and that financial system quietly pricing their survival. And most of the people, when they're buying an off-plan property, they're usually focusing on the layout, payment plan, views, and the launch hype, which these things are important and they matters, but that's not the real layer, and that's not everything, especially an off-plan. Why? Because in off-plan, you are not only buying real estate. In fact, you are underwriting the developer, and you are trusting their ability to survive long enough and to actually deliver, and not only that, but also maintaining the property long after delivering it. And this is where, unfortunately, most of investors fail, because they're watching the construction site instead of the financial system behind it. But it's a fact that the financial system sees things very differently. For example, in stress periods, markets stop listening to marketing, and the market stop caring about slogans, and also stop caring about the social media hype. And instead, the market actually here starts pricing risk, and it starts pricing risk specifically through bond spreads, and the bond spread is measured in basis points. And here is a quick simplification. Developer raises bonds from investors to fund their projects. Now think of bond spreads as the market stress meter or a stress indicator. The higher the spread, the riskier the bond become to the investor who lent the developer. So the more expensive survival become, which lead to increase the interest rate on the bonds. Now every 100 basis points is basically 1% extra interest. So when a developer sits around 200 basis point or below, the market sees them as relatively healthy, while at 500 basis point you're entering the risk territory. But once the spreads crosses the 1000 basis point, the market here is no longer pricing growth, but it's pricing survival, and they call it distress territory or stress territory. And at that level, the developer are effectively borrowing money at a credit card pricing, but for projects worth billions of dirhams. And that's of course not normal financing. In fact, it is distress pricing. And this is where the system becomes dangerous for retail investors, because most of investors, they don't look at this layer. Let's start here with the Emaar. People always say Emaar is strong, but what does that actually mean? Especially in numbers. It means 25 billion dirhams in cash, more than 120 billion dirhams in backlog, which means, in other words, future revenue is already secured. And Emaar debt level is so manageable that they could clear their obligations in less than a year. Emaar earnings cover interest obligations roughly 24 times over, and that's an extremely powerful interest coverage position. And this creates completely different equation. With Emaar, you're not funding survival, but you are entering an already capitalized system, and that advantage and that position is very difficult to replicate. Why? Because Emaar, along with other governmental backed developers, has a structural or special access, and that special access is giving them access to lands, best locations, capital, financing, and of course positioning. And that equation create for those developers a resilience across market cycles and market fluctuations. Now here where things become more interesting, because strong sales does not always mean or automatically means low risk. For example, let's look at Omniyat. Omniyat bond spreads moved into distress territory, but at the same exact time, their bond issuance was oversubscribed by nearly 3 times. In other words, they asked for 600 million dirhams, but investors offered almost 1.8 billion dirhams. So here the market is saying two things simultaneously. The market here is saying higher risk, higher reward. Why? Because institutional investors, they are willing to take higher risk for, of course, higher return. And these are the yield-driven players. They understand the danger and they're pricing it accordingly. And of course, they are trusting the brand and trusting the developer and the people and the founder behind the developer. Now, on the other hand, look at Binghatti. The Binghatti bond spreads move into the same distressed territory, rating placed under review with negative outlook pressure. Yet at the same time, the construction continues and also sales continues. And this is exactly where retail investors become confused, because construction speed does not equal or mean financial strength. And what you see physically is not necessarily what the financial system sees. So yes, a tower can keep rising while financial pressure builds underneath it. And this is why the market starts separating into survival categories. First, the governmental backed developers or layer, such as Emaar, Dar, Dubai Holding, and others. Those are institutional support and structurally stable. Then we have the retail fortress layer, such as Majid Al Futtaim, recurring cash flow, strong operating income, and defensive positioning. And third, we have the integrated builders like Shuba. They controlling construction internally, so this reduces the execution risk drastically, especially through their supply chain control. But even though this type of developer is still exposed to pricing cycles. Then fourth come the leverage sensitive layer, like DAMAC and other private sector developers in different sizes and scale. Yes, they offer more flexibility, but they are higher sensitive to market cycles. And yes, short-term stability may remain manageable, and long-term debt visibility still not 100% clear. So the real question here is not, is this project beautiful? But the real question that you should ask, who has the financial capability to survive the full cycle? Because in some cases, unfortunately, you are not investing, but you are financing as an interest-free funding source. For a developer, the banks would price very differently. And the banks also charge interest. Why? Because they understand the risk. But here, many investors absorb the risk without receiving the protection. And this is exactly why I only deploy capital with top-tier governmental-backed developers. Not because of branding, but because of structure. And yes, most of the market is just noise. And the next phase will not reward blind optimism, but it will reward clarity. Because in real estate, you are not only choosing assets, but you are choosing a system you trust to survive the cycle. And through Archi Lens, we don't chase the market. In fact, we decode the structure and position within it.